Hello, everybody. I'm Danielle Keynes. This is Accounting 1030, and today I'm going to solve a problem in Chapter 2. It's E2-10. So in this problem, E2-10, it's asking us to create journal entries for these six transactions that took place in May for Liam Darish's business. So besides doing the journal entries, we're going to practice a little bit of doing putting our entries in T accounts also, besides doing the journal entry. So let's walk through that. Remember that, let's go over the basic accounting equation. So assets equals liabilities plus owner's equity. So that's our basic accounting equation. We have to always make sure that our assets are equal to our liabilities and our owner's equity. We have to make sure that our debits equal our credits. As you can recall from a T account, when we looked at T accounts, that the debits go on the left, credits go on the right. So debits left, credits right. And coincidentally, asset accounts, their normal balance is a debit. The normal balance of liabilities and owner's equities accounts are credits. And therefore, assets equals liabilities plus owner's equity. Debits equals credits. So as long as you have two accounts, as long as you have a debit and you have a credit, you will always balance back to our basic accounting equation. Let's look at a couple of other accounts too besides assets. So, an asset is something that you own. So if you're going to increase an asset, it's going to be a debit. If you're going to have more of a liability, for example, more of a bank loan or accounts payable, you're going to credit it. Our owner's equity account is a credit account. There are a number of accounts that affect owner's equity. So the capital account, so the owner's account, that's a credit account. Now the owner's withdrawals, that reduces owner's equity. So because it reduces owner's equity, it's going to be normally a debit account. So when we increase a withdrawal account, it's going to be a debit because it reduces owner's equity. If we look at our little T account here, if you have a credit and you're going to reduce your credit, you are going to reduce it by creating a debit. The revenue account is it increases owner's equity, so it's also going to be a credit account. So revenue is going to be a credit. Expenses, on the other hand, reduce owner's equity. So because they reduce owner's equity, they are going to be a debit. So keeping that in mind, let's look at our 6 transactions and let's take a look at creating them in T accounts, putting them in their T accounts. The first one, May 3rd, owner Liam Darish invested $2,500 cash into the business. So the first thing we have to think about, okay, what 2 accounts are we dealing with here? So here it says we have the owner's account, Liam Darish, and we have Liam invested $2,500 in cash. So then we look at the accounts. Okay, we have a cash account. What account is cash? Cash is an asset. Are we increasing our asset? Yes, the owner is investing $2,500 cash into the business. So he's putting $2,500 into the business, increasing an asset. So it's going to be a debit account. So here we're going to have cash. Sorry. Just reduce that for a second. We're going to have cash. And we're going to have the owner's account. How we depict the owner's account is Liam Darish, so the name of the owner of the business, comma, capital. So that's the capital account. We're going to debit $2,500, and therefore the capital account we know is credit account. The owner's capital account is a credit account. It's increasing, so we're going to credit Liam's account for $2,500. That's our first entry. The second one, he rented a sound system and paid 1 month's rent. So he's saying he paid 1 month's rent. So that means you paid in cash if you're paying. So therefore we have one account, cash, and he rented the sound system. So he's got a rent expense. Rental expenses are a debit. So we know we're going to have a rental expense. This is going to be our debit account. And we always do our debit first. So we're going to debit it for $1,100. And we have our cash account, which is our credit account, because we're decreasing cash. Now remember, we have already $2,500 in our cash account from our first transaction. So here we're going to reduce our cash, credit it by $1,100. So we're paying an asset. We're not increasing an asset, we're decreasing an asset. So therefore it's going to be a credit, because assets increasing are debit accounts. So here we will be crediting cash, $1,100. The third one is we perform DJ services on account. So they said we perform services, so that means revenue. We performed some kind of a service, and so that's our revenue. And they said we performed it on account. So that means we didn't get cash. That means that our customer is going to pay us in the future, and the account that we use for our customers paying us is accounts receivable. Accounts receivable is an asset, is something that our customers owe us, and we are increasing accounts receivable. We're going to have more accounts receivable because our customers are going to owe us more. So it is going to be the debit account. So we're going to get $1,700 debit accounts receivable. And our other account was service revenue. Because we performed services, revenue is a credit account. So the normal balance of revenue, because it increases owner's equity, is a credit account. So we're going to credit our revenue, $1,700. Debit equals credit. So we have a debit, we have a credit. Paid cash for equipment. Well, cash is cash. We know cash is an asset, but also we're buying equipment, and equipment is something we're going to have a useful life. It's going to be used into the future. So therefore, the equipment is also going to be an asset. So we're increasing our equipment. That's going to be a debit. We're reducing our cash. So we're reducing an asset. So cash is going to be a credit because it's the one that's going to be reduced. So we're going to have our two accounts here, equipment and cash. We already had some cash entries here, so I'm going to show you those. This is we're keeping a running balance of our T account. So cash, we already had $2,500 debit, and we had $1,100 credit. But in this entry, we're increasing our equipment, so we're going to debit this asset, $600, and we're reducing our cash. We're crediting our cash for $600. Again, we have a debit and we have a credit, so we're in balance. The next one, the owner withdrew $500 cash for personal use. So again, cash is an asset. We are reducing the asset. So if we were increasing the asset, it would be a debit. So in this case, we know it's going to be a credit. So we're going to increase our cash or decrease our cash. We already had $2,500, $1,100, and $600 from our previous entries. So we're going to have a credit for cash. And the owner withdrew cash. So how we depict the owner withdrawals is we use the owner's name, Liam Darish, comma, withdrawals. So remember when we had the capital account, when Liam was investing in the business, we used Liam Darish Capital. In this case, we are withdrawing. And notice we don't use the capital account. We don't just debit the capital account here. We keep track of the fact of all of the withdrawals. So we are having its own account, Liam Darish withdrawals, and it's going to be a debit, because as we stated up here, owner's withdrawals are a debit account because they will decrease owner's equity. Okay, we have one more entry. We have purchased $40 of supplies for cash. In this book, we're purchasing supplies, and in this book, the book treats supplies as an asset. Some companies will expense it, but in this book, they're treating it as an asset. So we are going to increase our asset, our supplies, for $40. And again, we're going to be reducing our cash because they said we're paying for it in cash. So we're going to be reducing our cash by $40. So here's our $40 entry for cash. So we're debiting supplies and we're crediting cash. So we have all of our, we have one debit and one credit for every entry here. So we're in balance. And now we're going to put those into proper journal entries. So we're going to take all these accounts that we just put in our T accounts, and we're going to convert them into journal entries. So the first one was cash, Liam Darish Capital. So debit to cash, credit Liam Darish Capital. It was May 3rd is our first entry. So we put May 3rd here. And we're going to do our debits and our credits. So we're going to debit our cash, $2,500, and we're going to credit Liam Darish Capital, $2,500, just like we did when we did our T account here. We debited cash, and we credited Liam Darish Capital. Then we also provide a description in a journal entry. The third item is to make a description of what this journal entry is about. And in this case, the owner invested cash in the business. So you make a little statement about what this entry was about. Notice that cash, the debit entry, always comes first in a journal entry. So always your debit will come first. And if you have more than one debit, it will you'll list it, all the debits first, and then the credit. So Liam Darish Capital is a credit. Also notice that you indent the credit account just a little bit. So when you glance at this journal entry, you can already tell, even without looking at the numbers over here, that cash is the debit account and Liam Darish Capital is the credit account. You make like I said, an explanation here, and then you skip a line, and then you go on to your next entry. The next entry was May the 4th. Just a second, that. May the 4th. And let's go back, look up and see what our debits and our credits were. So we have a rent expense, $1,100, cash, credit, $1,100. So our rent expense. So we have a debit to rent expense, $1,100, a credit to cash, $1,100. And then we have our explanation that we paid for 1 month's rent for equipment. And also notice we're not doing anything for the posting reference. We don't update the posting reference until we post these to our general ledger. So this is the journal that we're using, we're putting our entries in right now, the book of the original entry. And then only when we post them to our ledger do we put in the post reference. Our next was we performed DJ services on account. So we're debiting accounts receivable and crediting service revenue. So debit to accounts receivable, credit to service revenue. Let's skip those entries. So it's May 6th here. A debit to accounts receivable for $1,700, a credit to service revenue for $1,700. We performed DJ services on account. So it's our accounts receivable entry. We come back up to our May the 11th entry, and we bought equipment for cash. So we're going to debit equipment, and we credited cash. So debit equipment, credit cash. And this is May 11. Oops, sorry, 2 ones there. May 11. We're debiting our equipment, crediting cash for $600, and our explanation. We purchased equipment for cash. Our next entry is Liam Darish. He withdrew $500 for personal use. So that's our Liam Darish withdrawals account is our debit, and our cash is our credit. 14. Liam Darish withdrawals, and that is for $500. And we are crediting cash because he took cash out of the business. And our description is that the owner withdrew cash for personal use, not cash, cash. And our last entry was we bought supplies for $40. So we're going to debit supplies, an asset, and we're going to credit cash. Maybe 18. Debit supplies, credit our cash, and our explanation. Purchase supplies for cash. So always remember, in a journal entry, you have your date, you have your debit account always comes first, your debit amount, your cash is indented just a couple of spaces, you got your credit, you have put your credit, and then you put an explanation, you skip a line, and then you have your explanation. So that concludes problem E2-10 in chapter 2. I'm Danielle Keynes, and thank you.